Regular viewers will know that for much of the summer, going into and after Brexit, we have been underweight equities. Generally, we've been cautious. We have added risk in certain areas where value has been attractive, banks, debt and emerging markets, for example. But overall, the view on equities has been to be underweight. Our process has told us to be underweight. Equities look expensive. Earnings, for example, have been weak. We get year-on-year negative growth in earnings in the US, for example. But over the course of the summer, we've been looking at the post-Brexit rally and just pointing at this and saying this is strange. It doesn't add up. We've had extremely low volatility on low volumes. Let me give you a bit of detail. August has been the lowest volatility month in the US in 20 years. We've had the lowest volumes in 3 or 4 years. The same in the FX market. FX volumes have been falling and volatility has been falling as well. In the treasury market and in the equity market, we've had the narrowest trading range through late July and August that we've seen in well over 20 years. So it's been a very strange marketplace. But all of that is now changing. In 1 or 2 sessions, the equity market has now given back the gains of the last 2 months. And I think what we ask ourselves is what's prompting this? Will it continue? I think there's a number of things to look at. One is politics. The political calendar is getting more and more busy. In Europe, for example, we have an EU summit at the end of this week where the EU leaders will interrogate Brexit and the future of Europe. We await the date of a referendum in Italy, the same in Austria on the rerun of the presidential election. And in Hungary, we have a referendum in October on refugee movements. They're just some of the events. Bear in mind, we have elections next year in Germany and France, but it seems like the electoral campaigns for those have already started. And then, of course, we have the first televised debate in the US presidential election on the 26th of September. And that election has taken another turn with the revelation of Hillary Clinton's recent illness. So plenty to play for. I think one of the factors that has maybe puzzled investors is the fact that politics hasn't seemed to matter much to markets recently. There was a time when political events, action, inaction could drive markets, but it hasn't been the case recently. I think the reason for that is the policies of central banks. Central banks have tried very hard with numerous QE programs to dampen down macro volatility, to dampen down interest rates. But by virtue of doing so, they also dampen down the inaction or the actions of politicians in the US and Japan and of course in Europe. And that makes us all less sensitive, and maybe less sensitive than we should be to politics. But perhaps that's beginning to change. The central banking diary is also a very, very busy one. We just had the ECB meeting where the ECB, for the first time in quite some time, has declined to add to its programme. We have a Bank of England meeting coming up where I think after the summer's action, the Bank of England will simply step back from making any new policy moves. And then on the 20th and 21st of September, we have headline meetings from the Bank of Japan and the Federal Reserve. It's not too clear from the Bank of Japan statements, in particular the governor's communications, as to whether he will do anything new, push negative rates down even further. We suspect that with mixed macro data, unemployment being very low, the Bank of Japan will hold off. And that puts a lot of focus on the Federal Reserve. Federal Reserve has had a difficult year or two in terms of the effectiveness of its messaging, communication, and the alignment of its various members. And my sense is that recently there is an effort by Janet Yellen to align people better. And recently we've had quite a few Fed governors coming out and saying that they would be ready for a rate increase in September. The data would permit that, but the market disagrees, and most economists disagree with that. They say that the Fed shouldn't raise rates ahead of the election when LIBOR is so high. But I have a sense that maybe the Fed is just trying to align itself and its members for a rate increase in September. If that's the case, that means more market volatility. I think the determinant of market volatility is going to be positioning. During this strange period of calm we've seen in the summer, a lot of people have added slowly to positions in US equities. to treasuries. And I think some of the violence of the last 1 or 2 days trading sessions suggest that those positions are now being unwound in a forced manner. And I expect that to continue for the next week or so. And this takes us up to the Fed. So for the moment, we stay underweight. And I think we just look and continue to look into this volatility to see if any opportunities emerge. Thank you.